Look closely at your calendar. It is Monday, February 23rd, 2026. The silence you are experiencing right now in these final hours before the global market open is not tranquility. It is the eerie, suffocating calm that immediately precedes a systemic financial earthquake that will rip through every economy on Earth. In just a matter of hours, the Asian markets will explode, and a monetary shockwave that has been building relentlessly and secretly for over 15 years is about to detonate with catastrophic force. We are no longer dealing in macroeconomic theories, abstract yield curve projections, or the polite academic debates of the past decade. The brutal, unforgiving mathematics of absolute scarcity have finally arrived at our doorstep, and the global financial system is about to face a violent physical reckoning that absolutely cannot be solved by central bank printing presses, emergency rate cuts, dovish pivot speeches, or digitized bailouts. The age of monetary miracles is over. Welcome to Dark Macro. I am your host, John A.G. If you intend to navigate the sovereign debt apocalypse currently unfolding around us with your wealth not just intact, but exponentially multiplied, you require unfiltered, institutional-grade intelligence. I urge you to subscribe to this channel right now, and more importantly, join my private WhatsApp intelligence group using the link provided. The era of financial illusions, of endless quantitative easing, and of blind faith in paper promises has officially collapsed. We deal only in hard reality in real time. What you are about to hear is the exact architecture of the greatest wealth transfer in modern human history, and you have less than 3 hours to position yourself correctly. To understand the magnitude of what begins tomorrow morning, you must first strip away the noise of the mainstream financial media and face the absolute structural fracture of our global money systems. For 40 years, the world has operated under a dangerous hallucination. We constructed a global monetary architecture based entirely on the concept of infinite debt expansion and the supreme dominance of unbacked fiat currency. Governments convinced themselves that they could run multi-trillion-dollar deficits into perpetuity, continuously rolling over unpayable sovereign debt by simply issuing more bonds, which central banks would invariably monetize with freshly printed digital currency. But as we stand on the edge of this abyss in 2026, the music has categorically stopped. The global debt to GDP ratio has breached levels that mathematically guarantee either sovereign defaults or hyper-debasement. There is no third option. The bond market, once the bedrock of global collateral and the foundation of institutional wealth, is actively repelling capital at a terrifying velocity. We are witnessing an unprecedented buyer strike. Foreign central banks, sovereign wealth funds, and the apex predators of institutional finance are no longer willing to finance the reckless fiscal deficits of Western nations in exchange for yields that are aggressively negative in real inflation-adjusted terms. This is not a mere cyclical downturn. It is a profound, irreversible de-dollarization and a systemic crisis of confidence in the very ledger systems that have governed global wealth since the Bretton Woods Agreement collapsed. The geopolitical landscape has violently bifurcated. We have watched the rapid deployment of tokenized commodity-backed cross-border payment systems by the BRICS plus nations, a move designed specifically to bypass traditional dollar clearing rails and destroy American financial hegemony. The Global South has recognized the inherent vulnerability of holding their national wealth in the digital liabilities of another nation. Consequently, central banks worldwide are quietly engaged in the largest accumulation of physical off-ledger assets in modern history. They are systematically rebalancing their national portfolios away from paper currencies and toward tangible reserves that cannot be hacked, frozen, or sanctioned. The fiat promises of the past are fraying, and the global market is ruthlessly, desperately demanding collateral that cannot be printed, digitized, sanctioned, confiscated, or wished into existence. Amidst this macroeconomic earthquake, one specific asset is rewriting the entire narrative of global wealth and stepping out of the shadows to claim its rightful place at the center of the monetary universe. It is an asset that has been historically misunderstood, violently manipulated by corrupt banking cartels, and chronically undervalued by ignorant retail investors. After a staggering surge in 2025 and shattering every psychological barrier earlier this year, silver has transformed from a forgotten secondary metal into the most powerful, coiled, and explosive asymmetric opportunity on the global financial board. We are officially entering our 6th consecutive year of a severe, unyielding structural supply deficit. Let those words sink in. For 6 years running, the world has been physically consuming tens of millions of ounces more silver than the Earth's crust is yielding. We have been bridging this massive chasm by draining the above-ground stockpiles, emptying the vaults of London and New York, and cannibalizing the scrap market at unsustainable rates. But those above-ground stockpiles are mathematically finite, and the vaults are now echoing with the undeniable sound of depletion. The shelves are bare. Do not make the fatal mistake of viewing silver merely as a shiny rock or a poor man's gold. Silver's true terrifying power in 2026 lies in its absolute dual identity. It is simultaneously the ultimate historical monetary safe haven and the indispensable absolute backbone of the modern technological arms race. You cannot engineer the future without it. Silver possesses the highest electrical conductivity, the highest thermal conductivity, and the highest reflectivity of any element on the periodic table. There is absolutely no synthetic substitute that even comes close. Every high-efficiency solar panel blanketing the globe, every electric vehicle rolling off an assembly line, every smartphone, and the massive sprawling electrical infrastructure required to power the explosive exponential growth of artificial intelligence, data centers demands physical silver in staggering quantities that the mining industry cannot possibly supply. Consider the sheer scale of the artificial intelligence revolution we are living through right now. The data centers powering advanced AI models are ravenous consumers of electricity and generate immense heat that could melt steel. To prevent these supercomputers from catastrophic meltdown, the industry relies on advanced silver-based thermal pastes, highly conductive silver-coated switches, and heavy-duty electrical relays that utilize silver's unique resistance to arcing and oxidation. As sovereign nations and megacorporations engage in an existential arms race for AI supremacy, they are simultaneously igniting a demand shock for silver that the mining sector is completely mathematically unequipped to handle. We have engineered a utopian technological future entirely reliant on an element that is becoming increasingly critically scarce, exactly at the historical moment when global investors are desperate for a hard monetary safe haven. The perfect storm has arrived. The supply side of this equation is equally disastrous and permanently constrained. You cannot simply flip a switch and mine more silver to meet this explosive technological and monetary demand. Nearly 70% of all silver produced globally is mined as a byproduct of base metals like zinc, copper, and lead. This means the global supply of silver is largely inelastic to its own price. Even if silver prices were to triple overnight, a copper mine is not going to fundamentally alter its massive operations just to extract a slightly higher yield of byproduct silver. The economics do not work. Furthermore, the geopolitical choke points of silver production are tightening like a noose. The primary producing nations in Latin America have faced years of underinvestment, political instability, violent protests, and declining ore grades. Compounding this physical bottleneck, the aggressive export licensing regimes implemented by major Eastern powers earlier this year have effectively choked off a massive artery of global refined silver supply from reaching Western markets. The physical material is being hoarded domestically for strategic industrial and military applications. This is economic warfare by resource control. This fundamental mismatch between explosive price inelastic demand and constrained price inelastic supply is the bedrock of the crisis. But what turns this fundamental reality into an imminent financial explosion is the grotesque structure of the paper derivatives market. For decades, the global price of silver has not been dictated by the buyers and sellers of physical metal. It has been dictated by the trading of unbacked paper contracts, futures, and derivatives on exchanges like the COMEX and the LBMA. Bullion banks and institutional short sellers have utilized extreme leverage and fractional reserve practices to suppress the price, issuing hundreds of paper claims for every one actual physical ounce sitting in a registered vault. It has been the most egregious game of financial musical chairs ever conceived. They sold the illusion of infinite liquidity, relying on the fact that the vast majority of investors would simply settle their contracts in cash rather than demand physical delivery. But the psychology of the market in 2026 has violently shifted. As the sovereign debt crisis accelerates and inflation destroys the purchasing power of fiat currencies, industrial titans and institutional whales are waking up to the vulnerability of holding paper promises for critical raw materials. A paper contract for silver cannot conduct electricity. A paper derivative cannot manufacture a solar cell. A digital receipt cannot guide an advanced missile system. Industrial users are realizing that if they do not secure their physical supply chains right now, their multi-billion-dollar production lines will grind to an absolute halt. This realization has triggered a quiet, ruthless run on the physical vaults, We are witnessing the immediate physical draining of global depositories as entities demand actual delivery of the metal they purchased. The paper game is ending. This brings us directly to the countdown to the very specific mechanics of what is unfolding right now. As we approach Monday morning, the paper market is rapidly mathematically running out of the leverage required to maintain its suppression. The ratio of paper claims to physical metal has stretched beyond the breaking point, and the rubber band is snapping back with devastating force. What we are going to witness when the opening bell rings is not retail speculation, Reddit-fueled meme trading, or short-term technical chart movements. It is institutional price discovery in its purest, most aggressive, and most violent form. The physical market is finally rising up to dictate terms to the paper market. The multi-year ceilings and technical resistance levels that algorithmic traders have relied upon have been thoroughly shattered and obliterated. We are entering a phase of the market known as a short squeeze, but on a macroeconomic foundational scale that has never been witnessed before. As the price of physical silver continues to gap higher, the institutional entities heavily short the paper market will face insurmountable margin calls. To cover their short positions, they are forced to buy back contracts at any price, pouring highly combustible fuel onto an already raging inferno. This creates a self-feeding parabolic loop of price acceleration that feeds on itself. Simultaneously, the gold-to-silver ratio, historically sitting at distorted elevated levels, is actively and aggressively compressing. While gold remains the primary Tier 1 reserve asset for central banks, silver is the coiled spring ready to explode. Historically, in every major precious metals bull market, gold leads the charge. But silver eventually catches fire and vastly outperforms gold on a percentage basis due to its smaller market capitalization and immense industrial torque. That phase of outperformance is not a future projection. It is the exact reality we are stepping into this week. Think deeply about the psychology of the institutional money managers sitting at their desks across London, New York, and Tokyo right now. They are staring at a global economy where commercial real estate is toxic, equity valuations are stretched to historical extremes despite declining corporate margins, and government bonds offer guaranteed losses in purchasing power. They are desperate for a narrative that makes sense, for an asset class that possesses true, unencumbered value. When they look at silver, they see the perfect storm, an asset crucial to the survival of the tech industry, an asset with a 6-year structural deficit, an asset experiencing a physical bank run, and an asset that acts as the ultimate hedge against sovereign debt collapse and currency debasement. When that wall of institutional liquidity decides to aggressively enter a market as small and physically constrained as silver, the price movements will be absolutely breathtaking and historic. The window to position oneself ahead of this historic revaluation is closing with terrifying speed. Every hour that ticks closer to the Asian market, open removes a fraction of the remaining opportunity to acquire physical assets at prices that will soon be viewed as a laughable historical anomaly. The forces driving this shift are deeply embedded in the laws of physics, thermodynamics, and mathematics. You cannot negotiate with a structural supply deficit. You cannot print a highly conductive metal out of thin air to appease a hyperinflating economy. The global monetary reset is not a conspiracy theory reserved for the fringes of the internet. It is a mathematical certainty playing out in the balance sheets of every major central bank and industrial powerhouse on Earth. As we cross the threshold into tomorrow, we are crossing the threshold into a deeply fragmented, hyper-pragmatic world where only hard assets command respect. The illusions of the past decade are burning away in real time. Silver is no longer merely a trade to be flipped for a quick fiat profit. It has become a mirror reflecting the utter exhaustion of our global debt systems and the absolute undeniable physical limits of our planet. When the markets open in less than 3 hours, the entities and individuals who understand the profound mathematics of scarcity will dictate the financial future. Those who stubbornly cling to the financial illusions of the past, who trust in unbacked ledgers and infinite government debt, will be left paying an unbearable premium for survival or will be completely wiped out. The countdown has zeroed out. The structural deficit is absolute. The vaults are emptying and silver's big historic move is already violently underway. This is not a warning. This is not a prediction. This is reality crashing into your life right now. I am John A.G. This is the unvarnished financial reality of 2026. Stay relentlessly vigilant. Protect your wealth with hard assets, and I look forward to speaking with you directly inside the Dark Macro WhatsApp intelligence group before the markets open. The clock is ticking.